Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A market torn in two. The Nasdaq skyrockets to a new record while the Dow plunges as the Fed's rate shock triggers chaos. Is this the great tech decoupling? Second, big tech bloodbath. Meta implodes, plunging over 12% and vaporizing billions as the AI arms race collides with the Fed's hawkish reversal. While some giants soar, others are massacred. Is this the end of the Magnificent Seven era? Finally, AI's secret crisis. A Silicon Valley insider reveals the AI boom is built on a lie, with hidden costs threatening to trigger a market shock. Is the entire industry a ticking time bomb? And who gets left holding the bag when the bill comes due? Breaking news sends shockwaves through the financial markets. Fed Chair Jerome Powell's hawkish comments on future rate cuts have rattled investors, propelling the Nasdaq to fresh all-time highs while the Dow takes a nosedive. The S&P 500 remained flat, closing at 6,890.59, but the Nasdaq surged 0.6% to 23,958.47, buoyed by smaller tech firms, even as giants like Microsoft and Meta face headwinds. The market's focus today revolves around Powell's unexpected pivot, signaling that a December rate cut is far from certain. This abrupt shift from the Federal Reserve has left investors scrambling to reassess their portfolios, particularly those heavily weighted in interest rate sensitive sectors like real estate and consumer discretionary stocks. The 10-year Treasury yield spiked above 4%, reflecting the market's recalibrated expectations for future interest rates. Powell's remarks, coupled with dissenting votes from within the Fed, underscore the internal debate over balancing labour market weakness against persistent inflation pressures. For investors, this means portfolios may need adjustment to navigate a potentially prolonged period of elevated rates, which typically weigh on growth stocks and sectors reliant on cheap borrowing. In this environment, technology stocks have emerged as a focal point. Despite the broader market jitters, the tech-heavy Nasdaq outperformed, driven by robust earnings from smaller tech firms and infrastructure companies like Broadcom, which set new record highs. Apple, even while missing some analyst expectations, reported a record fiscal year, highlighting strong demand for its services and AI investments. Meanwhile, Alphabet's impressive revenue growth and cloud division performance have set it apart as a beacon of resilience in the tech sector. However, not all tech giants shared in the glory. Meta Platforms faced a significant decline after announcing hefty AI infrastructure spending plans, raising investor concerns over ROI in this high capital expenditure environment. Here's what to watch closely. First, keep an eye on next week's earnings from Meta and Apple. If their results disappoint, particularly with Apple's guidance on AI expenditures, the Nasdaq's 23,500 support level could be tested. Second, monitor the bond market closely. If the 10-year yield continues its ascent beyond 4.3%, it could spell trouble for growth stocks, prompting a sector rotation into defensive players like utilities or consumer staples. These movements will be crucial for investors looking to balance risk and opportunity in the coming weeks. Now let's take a closer look at the specific stories driving today's action. The Federal Reserve just threw a wrench into Wall Street's plans. After delivering a quarter-point cut, and with the market pricing in another one with over 90% certainty, Fed Chair Jerome Powell went on the record stating a December cut is not a foregone conclusion. Investors are now scrambling. A while back, we analysed how a more market-reactive Fed and the unresolved battle over future leadership would make forward guidance less reliable and volatility higher. Well, this pushback is that playbook in action. So the thing is, the Fed is trying to regain control of the policy narrative. For months, the market has acted as if rate cuts are guaranteed, a concept some call the Fed put, the belief the Fed will always step in to support asset prices. By challenging this assumption, Powell is introducing more uncertainty and volatility. Actually, this isn't just a whim. It's a strategic move to give the Fed more flexibility to react to incoming data rather than being locked into the market's expectations. Remember our previous note. In periods when the Fed leans into real-time decision-making, the dot plot matters less and descents matter more. So if we see dovish descents, that's your tell. As the market tests the Fed's resolve, Keep an eye on the 10-year break-even inflation rate. It remains the pressure gauge for whether investors believe the Fed will tolerate slightly higher inflation for growth. And that wasn't the only shock. In a major geopolitical shift, US President Donald Trump met with Chinese leader Xi Jinping, striking a one-year deal on rare earths. As part of the agreement, the US is immediately halving fentanyl-related tariffs on Beijing from 20% down to 10%, and in return, China will resume buying American agricultural products. A few episodes ago, we flagged the risk that a politically driven Fed could spill the US-China rivalry into a currency front. Today's development isn't that. It's a targeted de-escalation, useful for supply chains, but not a wholesale reset. Keep watching the dollar-yuan dynamic as a barometer for whether this transactional calm holds. Now, get this. This isn't just a simple trade. It signals a potential new phase in US. China relations, some experts are calling managed competition. The idea that even with broad rivalry, both sides can find specific areas for transactional deals. This creates pockets of predictability, which is good news for sectors like American agriculture. For Chinese audiences, interestingly enough, this doesn't reverse the long-term trend. China has been strategically diversifying its agricultural supplies, especially for soybeans, buying more from South America. So while this deal provides short-term relief for US farmers, the underlying competition remains intense. The rare earths agreement also reveals a dual-track US strategy, securing a one-year supply from China as a buffer while working with allies to build a long-term independent supply chain. The success of that long-term strategy will be critical for Western tech and defense manufacturing. But the real fireworks were in big tech earnings. While Alphabet and Microsoft beat expectations, with Google's parent company soaring over 4%, Meta imploded. The stock plunged a staggering 12.59%, vaporizing billions in market value. This isn't just about one bad quarter, it's about a high-stakes war for the future. As we said a while back, markets are great at pricing the next move and terrible at pricing the next regime. Earnings are telling you who's investing to define that regime. The situation presents a fascinating duality. On one side, you have what some are calling the Powell put, getting weaker as the Fed signals it might not cut rates. On the other, there's an increasingly powerful AI call option, the belief that massive AI investment will unlock huge future profits, justifying sky-high valuations for a select few. This conflict explains the growing divergence we're seeing between the tech-heavy Nasdaq and the rest of the market. And tying back to the Fed, remember our earlier point, if leadership uncertainty lingers, short-term volatility rises, but that doesn't stop companies from committing to multi-year capital expenditure cycles. But that's not the whole picture. The real turning point is that all three tech titans, Alphabet, Meta, and Microsoft, signaled they will blow past their previous spending projections. The reason? A relentless, accelerating arms race in artificial intelligence. They now expect capital expenditure growth in 2026 to outpace this year's already frantic rate. Even the Fed chair suggested AI is a major source of GDP growth, not a repeat of the dot-com bubble. We've also discussed how the Fed can separate its tools rate, guidance versus liquidity, so don't be surprised if policy tries to lean against overheating without snuffing out AI-driven investment. This synchronized spending spree is the most tangible bet yet on an AI-driven productivity boom. This spending or capital expenditure is a key part of what's called non-residential fixed investment, a major component of GDP. When companies invest this heavily, it's a strong signal of confidence in future growth. If this AI investment really does boost productivity, it could allow for higher overall economic growth. Believe it or not, this is crucial because it might even make the Fed more tolerant of slightly higher inflation, as long as it's accompanied by genuine productivity gains. This is the core argument that this isn't just another bubble, but a fundamental technological shift. While the Fed plays chess with the market and world leaders redraw trade lines, a new reality is taking shape. The AI spending spree is a multi-billion-dollar conflict where the price of entry is record-breaking investment and the cost of falling behind is total irrelevance. And as we've cautioned before, with the longer-term fight over who steers the Fed still unresolved, expect the path to that future to be bumpy, even if the destination is bigger, faster growth. Speaking of the immense cost of the AI race, a bombshell claim from a Silicon Valley insider suggests the situation is even more precarious than it looks. Palantir co-founder and venture capitalist Joe Lonsdale just went on the record with a stunning warning, claiming AI executives are, quote, afraid to scare their investors, and so they are telling them they need a lot less capital, a lot less energy than they know they actually do. The result? Lonsdale predicts a continuous cycle where these same companies will be forced to return for more funding and more power every 3 to 6 months just to keep the lights on. A while back, we warned that even Sam Altman said the market was getting overexcited. The twist today is different. Lonsdale isn't calling a hype bubble. He's saying internal budgets are understated, so the scramble for dollars and megawatts will hit in waves. Here's where it gets interesting. This isn't just a prediction. It's a pattern we're already seeing. In finance, these massive investments are called capital expenditures or capital expenditure, a crucial leading indicator of future growth. What Lonsdale is describing is a cycle of underestimation followed by constant upward revisions reminiscent of the dot-com boom. For example, Microsoft's capital expenditure is projected to nearly double to almost $70 billion next fiscal year, and Alphabet recently increased its own guidance by $10 billion. When companies repeatedly need more cash than they admit, it puts huge pressure on their finances and can lead to sudden stock drops if they can't secure more funding. As we noted before, much of this build-out leans on debt, so the real test is whether these assets can earn before the funding runway shortens. This isn't happening in a vacuum. Tech giants are already on a historic spending spree. Meta, Alphabet, and Microsoft all recently boosted their capital expenditure guidance, with Mark Zuckerberg saying the company is aggressively ramping up investment in the race for superintelligence. This comes as companies like OpenAI command private market valuations of $500 billion. But the cost isn't just measured in dollars. The hidden story here is the staggering electricity demand behind this AI boom. Research shows that data centers, the brains of the AI revolution, are on track to consume a massive 11.7% of all US electricity by 2030, up from just 3.7% in 2023. We already walked through forecasts of roughly 60 gigawatts of new data center demand, about Italy's entire peak electricity load, and proposals from OpenAI and NVIDIA that would draw as much juice as New York City. And the infrastructure isn't there yet. Interconnection queues like Mesos are jammed, and natural gas turbines are largely sold out for the decade. For balance, we also flagged that the CEO of nuclear operator Constellation Energy told investors the load is being overstated, underscoring how uncertain these projections remain. However, if you zoom out, you'll see another layer to this story. While some on Wall Street worry about an AI bubble from overspending, Lonsdale's warning suggests the real issue is the opposite. His take, if anything, I think we're underestimating how much investment is going to go into this space and how much we're going to need. That sits in tension with the IMF's recent flagging of excessively optimistic AI expectations, a reminder that public hype and private capacity constraints can coexist. This massive need for capital and energy is so significant. It's becoming a geopolitical one, fueling a data center race between the US and China. For our Chinese-speaking audience, you can see this in China's Eastern Data, Western Computing Project, a massive national strategy to build data infrastructure in energy-rich Western regions to power data-heavy Eastern hubs. We previously framed this as an undeclared arms race shifting toward custom silicon, which only deepens the capital intensity and ties the investment cycle to national security policy. This raises a critical question: what is the real price tag for the future of AI? The core conflict isn't just about a potential bubble, but a fundamental disconnect between the public story sold to investors and the massive undisclosed resource demands powering the boom behind the scenes. And there's another hidden cost: inflation. The relentless construction of data centers is creating persistent demand for specific industrial goods and skilled labor. For instance, the producer price index for cement has been steadily climbing. This is a classic example of sticky inflation, and this new source of price pressure is worth noting because it's separate from consumer spending and complicates the job of central banks. We also pointed out before that the scramble for power is driving a focused inflationary shock across critical industrial components, keeping costs elevated even if consumer demand cools. So what should we watch for next? The key will be to observe if a divide emerges between two types of AI investments: the capital-intensive foundational model builders and the more capital-light companies building applications on top. Smart investors may start to shift focus from the picks and shovels of the AI gold rush to the companies delivering real, provable productivity gains. This potential rotation will be a key focal point in the coming months. Also, keep an eye on that utilities as growth re-rating we talked about. If AI forecasts get revised or grid delays bite, that trade can unwind fast.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.